Hi. In today's video, we learn how to analyze bases that often occur within trending stocks throughout their journey. When the price of a stock moves through a significant advance or decline, it very rarely makes the move in one go. It usually moves in a certain direction, stalls or consolidates before continuing in its move. At some point, the significant advance or deep decline gives up steam, and the stock can form a reversal base which can last for extended periods. Traders can use continuation or reversal bases to trade depending on their style. Whichever style you choose for trading, understanding the psychology and process behind these technical bases can be extremely helpful. For this video, we stick to bases within an uptrend. It aligns to my approach, and it is where much of the trading money is made in the market. When the price is in an uptrend, it can go up for several days and weeks. This up move comes because of heavy buying from both institutional investors and traders, often due to a change in fundamentals. As the move gets extended, it can trigger sell orders from traders who are in the stock for a quick move. There would also be short sell orders that will get triggered because the stock will technically be in a short-term overbought zone. Additionally, the institutional investors will be deterred from buying extended prices and often wait for the price to cool off before buying afresh. Because of this excess supply and lack of enough demand, the stock can fall or stagnate for days and weeks, and this invariably starts the formation of a base. The depth of the base will depend on the strength of the underlying fundamentals. If the shift in fundamentals is big enough and there is a room to be factored into the price, the base will not be significant. There could be too many up days or too few down days. However, if the fundamentals are still evolving and the market is waiting for more positives, the base can be significant. That said, the price should not give everything back in the base. Bases deeper than a third of the up move are more prone to failures. Another important feature of the base is the volume behavior, both in the up move and at the start of the base. The volumes are usually high in the move up and relatively lower in the move down when the base starts. If the volumes at the start of the base are higher than they were in the up move, there is a higher likelihood of base failure. As the base formation progresses, the price stabilizes and becomes relatively inactive. The volumes in this phase dry up, as the breakout traders like myself aren't yet interested. The short sellers slowly cover positions, and the institutional investors slowly accumulate on the dip. At some point, the institutional investors take over again and push the price up. Seeing the price going up on high volumes, traders also come to ride the move and take the price to the breakout level. Once the breakout happens, the breakout traders come in hordes and take the price further up. At this point, some short sellers also come and buy to cover their short positions taken at lower levels. All this buying activity helps the uptrends to continue, and the phenomenon then gets repeated in the next base until the uptrend gets exhausted and price reverses. The length of each base also varies depending on the strength of fundamentals. Stocks with great fundamentals don't spend much time in bases, while stocks where fundamentals are changing at a slower pace under the radar take their time basing. Therefore, the range of time spent in the base varies considerably, from between 4 to 65 weeks. Our scanning software is able to pick out stocks which fall into a basing pattern criteria and have broken out, making the task of trading such setups far less time-consuming. A question many traders ask is, how many bases are formed before the move is classed as exhausted? As per the CanSlim developer William O'Neill, the best bases to trade are from the second to the fourth base. Any base beyond fourth is more prone to failure. By then the story of the stock is widely discovered, and all the positives are getting factored in. You can still find higher base counts working in some stocks, but that's more the exception than the norm, and they provide a higher probability of failure. Let's look at a few examples of bases in an uptrend. Here is the weekly chart of a recent small-cap success, Elf Beauty Inc. The stock started its rally in June 2022 and has formed 3 short bases since then, in a 550% plus move. We can see how there were many up weeks and too few down weeks. The volumes moderated around the base and picked up strongly after breakouts in each base. The shift in fundamentals in this case had been the success of the company's affordable and trendy makeup products. The company has been topping earnings estimates for 4 quarters now and is the darling of many small-cap institutions. Let's now jog a little bit back in history to look at one of the best stock market performers of the last couple of decades. Here is the weekly chart of Apple Inc. from 2003 to 2005. The company was riding high on the success of iPod and MacBooks that led to the huge increase in earnings. The stock jumped 600% in a short time, making small bases throughout the move displaying similar characteristics that we discussed earlier in the video. There were more up weeks than down weeks, higher up volume than selling volume, and a shorter base size due to significant change in fundamentals. Let's now discuss how to identify the end of the move. As the move ends in these uptrending stocks, the price behavior becomes erratic. The lows and highs are too far apart. The stocks break the lows in the previous base. The subsequent bases become too close. The depth of the bases keep on increasing, and there is a high volume selling as institutions dump their way out of the stock. For example, here is a weekly chart of Nvidia, which became a stock market darling led by the success of its graphic processing units, or GPUs. As the gaming industry gained significant traction, its sales and earnings also saw a big jump for being the leader in the industry. However, as the move was about to end, the stock saw erratic price behavior, with bases that were bunched up together and showing signs of high volume selling towards the end. The end of one move, however, doesn't mean that the stock can't rally again. Nvidia continued to rally after the decline, backed by further increases in earnings and even better prospects of its new business ventures. However, the move came after nearly 2 years of stagnation, which can be okay for an investor, but not for traders looking to compound their equity at a faster rate. To compound our accounts as traders, we need to be in the stock at a near optimum moment. If not, we risk serious opportunity cost by being in a stock moving sideways, or worse, downwards. We also don't have to capture multi-year returns in stocks. We rather have to catch short to medium-term moves, whilst compounding these smaller returns using appropriate position sizing and risk management principles, something we discuss in more depth on the channel. Base analysis can be quite helpful in getting in on quick moves at the optimum time. We should understand these bases and differentiate between them on normal or abnormal price behavior. When the price behavior is normal, we can prioritize our trades based on the risk involved and the return potential. As with everything else in life, this skill is built with practice. We can look at one of our trades in the group which we closed on recently, Inter Parfums. There are 4 bases showing on the chart. We took a trade on the second base when it appeared on our scanner due to the lateral consolidation and breakout with volume. The first 3 bases were less erratic and more obvious than the fourth, which came with a series of upper wicks within the consolidation. As always, it's easy in hindsight, but this 4th base marked the end of the shorter-term move. We eventually exited a few weeks later due to the cross-down of the MACD, netting a 43% gain in just over 6 months, but perhaps more importantly, evading a further 13 weeks of stagnation. Understanding bases within a chart structure is just another tool for the trader looking to move probabilities into their favor. Hopefully you found some value. As always, thanks for watching, and if you've not done so already, please consider hitting the like button or subscribing to see similar videos in the future.